Hi guys, welcome to the page of Commerce Shikshaa. Today we will discuss 7 cash management tips for every business owner. सब अच्छा चल रहा है, everything is fine, but still there is no cash. Where is the cash? Where is the cash? Today we will discuss 7 places to look for cash in your accounts. More accounts receivable means lesser and lesser cash. Many a times it happens that a lot of sales are showing in your profit and loss account, but there is no cash in the bank. It is a standard practice to give credit to your customers, which means that you deliver the goods with invoice and you collect the payment later. This is generally done to expand business, to have a good reputation with clients and get regular sales. Having said that, there should be a balance between giving credit and collecting it. Selling goods on credit is a standard business practice where you deliver the goods with an invoice and collect the money later. However, many a times it happens that you have a lot of sales showing in your profit and loss account but no money in the bank. It is really important to have a good collection period and policy in place and to keep revisiting your policy so that you have less bad debts and blockage of funds. Did you know more inventory also means less cash? Inventory is basically the goods that you sell. So, the investment that you do in your inventory means that you have less cash in hand. Many a times businesses hold a lot more inventory than needed, which is basically blocked cash, which could have been used for other purposes like marketing, for expansion, etc. The amount of money that you invest in your inventory should be in accordance with your sales estimates. However, most service industries would have less problems with the inventory because they would have less inventory or no inventory. The traders and manufacturers are the ones who really need to take care of their investments in their inventory. The third point is more accounts payable equals to more cash. Most businesses buy their products on credit. Just like you sell on credit, you also buy on credit. Ideally, you finance your AR and inventory from the credit that you receive from your vendors. You have to manage between paying late, paying on time, and stretching the AP without being late for payments and without having a bad reputation and without affecting your credit rating. It takes management. The satisfaction that you get from paying on time, owing nothing to nobody, that is not a good financial management. The next point is that the loans and the debt payments do not show up in your profit and loss account. Now, what is the meaning of this and why is it important for cash management? The debt repayments cost you money, but you won't know it if you don't track your cash flows. The interest part of your loans show up in the P&L, but the principal part, that doesn't show up. You have to watch and plan for it. Otherwise, you will not know where all your money went. Many a times it happens that you look at your expenses and you feel, okay, that is all that I have as a cash outflow, but principal debt is also a major part of your cash outflow. So you have to manage and you have to plan as to what is your outflow gonna be like and then manage your cash. Buying assets does not show up in P&L. It takes money to buy all your assets like land, building, equipment, machine, vehicles, but these don't count as expenses, so they will not show up in your P&L. So you have to be well aware and well planned as to some outflow regarding assets is coming up. So you have to plan ahead and see what your future outflow is going to be like so that you can manage your cash. Fixed cost versus variable cost decisions matter. The trade-off comes off often and it matters a lot. This area is full of choices you can make. For instance, do you hire a full-time employee or get someone on contract who has specialized skills? Fixed costs are generally lower than the variable cost, but they also come with higher risks. The last point is sunk costs don't matter. We so often think that we have to continue down on some path because we have spent so much money on it. It's hard to let that go, but the money already spent is a sunk cost. You don't get it back by spending more. So decide on the basis of a decision criteria which makes sense at that point. In any specific situation, the money already spent is never a good reason to spend more. I hope you enjoyed the video. Please like, share and subscribe.